Welcome back. Here we're going to talk about why EMH is so important. And there are three scenarios supporting EMH. So we're going to study that part, okay? This is very important as an economist, right? Why is it so important? Okay, 5 reasons. 1, in social planning perspective, it is important. 2, who wins and who loses in the investment? In that sense, EMH is important. 3, risk sharing among investors, it is very important. 4, incentive giving in corporate governance, EMH is very important. 5, resource allocation among divisions within a company. In that sense, EMH is very, very, very important. In essence, EMH is the centerpiece of neoclassical economics. Okay? 활용점정, it's like in Asian, the proverbs, right? It's like pointing the eyes of the dragon finally. Okay, you're drawing a dragon in fancy, sexy way, and you left the eyes over there, and you have to point that. Okay, you want to make sure these eyes look like dragon. Okay, that is the EMH over here. In many respects like this, EMH is essential. If EMH breaks down, all these economic theories start to crumble down. So for the sake of coherence of economic theories, you need EMH. So that's why the mainstream economists, like the guys from Chicago, Minnesota, Carnegie Mellon, they are fiercely supporting and protecting EMH so much, okay? So let's go one by one. Social planning, what does it have to do with it? Well, it goes back to Adam Smith, our Adam of economics, right? Classical economics, 고전파, right? 1776, the wealth of nation, okay? What was the most important thing in the wealth of nations, right? It was the invisible hand. What was the invisible hand, right? Price mechanism. Oh, so what was the claim, right? Price mechanism in a competitive market is the invisible hand that allocates the resources most efficiently, okay? Participants behave rationally in a selfish manner. Oh, isn't that bad? Ethically, you have to be altruistic or whatever. Let them be selfish. But with a minimum degree of law, just everybody abides by, okay? Rule of law is there, minimum degree, and then they will transact in the market. And then the price mechanism, which is the invisible hand, will take care of the rest of the things. So much so that the resource allocation will be the most efficient and that will make the most people most happy, okay? Don't worry, be happy. The invisible hand will take care of you naturally, okay? So this is a social planner's perspective. This is market mechanism, okay? Why did they worry about all these things? It goes back to, okay, how can a central social planner make everybody, most people happy? Okay, not everybody, but most people, okay? So one way of making people happy could be what? Communist way, okay? Assuming that the super elite in the center, okay, behave in such a way altruistically that he or she knows about your demand or whatever, but all in all, what do? Collect all the money and wealth from the rest of the society and divide it by n equally. That's communist world, okay? And then centrally we allocate the meal for you. Oh, you open your mouth and here is your meal, okay? The central government, Kim Jong-un in North Korea, okay? That crazy guy will feed you and you should feel happy and grateful. Otherwise you will be in Aoji, like a mining place, right? God knows what you would do. That's communist world, okay? Isn't it beautiful, communist world? Yeah, in your wildest dreams. But No man is an angel, right? That's the key point, right? The central governing party, the elite, okay, super elite, are they altruistic? Are they angels? No, hell no. No man is an angel, okay? That's this idea shows up in the Declaration of Independence of the United States or the Federalist Paper of the US, right? Western philosophy, okay? So in this Anglo-Saxon thoughts, right? Let the market take care of it, okay? The competition will make them more efficient, okay? So the invisible hand, the price mechanism, will take care of the rest of the things, the resource allocation, so much so that the most people will be most happy over here. Okay, that's the idea. In that respect, the price mechanism plays a central role of resource allocation. Shouldn't this price mechanism reflect all the information? Okay, that's why EMH is so important. Okay, central planner's perspective, social planner's perspective, I'm sorry. If correct, prices give us useful information about expected economic growth. So with that price mechanism reflecting all this, already reflecting information, our expectation about the future, we can back solve it. You observe the price and we can infer, what the market is perceiving. Okay, the market participants is perceiving right now, or so what can we do with it, right? Here, stock market index or price, okay, in the stock market works as a precursor to what's coming. Okay, the price, Dow Jones index or S&P 500 index, they will reflect the investors' expectation about what's coming in the future. So what I give you over here are two time series graphs. Okay, one is the time series graph of US GDP growth in time t in the red color, year by year up until 2022 from 1930. Okay, and then S&P 500 return. Okay, t-1. So yellow line. Right, these spiky ones are the S&P 500 index return a year ago. So whenever the price index return was good, going up, the next year the GDP growth was going up. Okay, whenever the S&P 500 return was going down, the next year's GDP growth was bad. Okay, so that's basically what we can see it. Okay, and if you look at a scatter plot, it looks like this. Okay, and the S&P 500 index return on the x-axis, GDP growth rate on the y-axis, and then you will see a positive association between these two guys. Okay, slope is positive, R squared very low. Of course, this is stock market in data, randomness, a lot of randomness, and then GDP. Not all of them is expected, should be expected by the stock market. Stock market is a predictor of future GDP growth, but it is not a perfect predictor. Okay, it's a partial predictor. That's what I'm saying. But has any information about the future. Isn't it good? Number two, why EMH matters. Who wins and who loses in the investing? The investing in the market has to be a fair game. Otherwise, nobody will participate. Okay? If I get ripped off, okay, why would I be there, man? I would avoid it. Okay? If over 100 years of time, okay, if people get out of the market, okay, the market will die out. Okay? Market has to be a fair game. If prices are right, average investors can't really make a mistake as long as they stay diversified. Rule number one in your investment as a rational person, diversification. Don't put all your eggs in one basket. Higher risk will be compensated with higher returns, and risk-return trade-off should be there. You remember those portfolio theory, okay? But if prices are not right, unsophisticated traders who don't understand the game, may lose money. More generally, irrational prices can arbitrarily affect allocation of wealth in the economy. So that's why EMH is so important to keep this market going on. Number 3, allocation of risk across investors. You remember financial management. You remember the risk-sharing idea in the portfolio theory and capital asset pricing model. Correct prices facilitate efficient risk sharing. What do you mean by risk sharing? Okay, what do you mean by risk sharing? Let's get back to your capital market line. Okay, capital market line. You remember those efficient frontier and then risk-free asset. We have 2 different assets in the world. One is risk-free, like US Treasury, default risk-free, and it will get back to you with promised return. Okay, risk-free asset, and the other is the rest of the stocks and then oils and then gold and then all this kind of the commodities, I would say, right? These kind of things are different from US Treasuries, right? Their prices fluctuate. And default risk is huge as well. Anyway, so risky asset, risk-free asset. What do? You first build efficient frontier, and then you draw a tangent line to that frontier, and so much so that it goes through, that tangent line goes through that risk-free asset on the y-intercept line. So what do you do with that capital market line? Well, all you have to do as a private banker is to listen to the risk aversion of your different clients. And if your clients are very risk averse, like grandpas and grandmas, you can allocate them so that their asset allocation should be close to this risk-free asset. US Treasury, maybe 100%, then no risky assets at all. Or alternatively, if your investor's preference is like risk-seeking, young blood, okay, what do? Well, 100% of their assets should be allocated to this stock market or risky assets on that efficient frontier, the tangent point, okay? Risk-free point, tangent point. And somewhere, okay, my kind of guys, middle-aged ones, right? I'm medium risk averse. Where do I stand? Well, my kind of guys, half and half. Okay, half of my portfolio in the US Treasury, half of my portfolio in the stock market index, S&P 500, 50-50. So that in the capital market line, that straight line, everybody will line up over there depending on their risk preference. Okay, that's risk sharing. Okay, but in this risk sharing process, okay, critically important assumption is that the market is efficient, so much so that you can build this kind of capital market line correctly, because you assume that the price is correctly reflecting the information. Okay, if EMH breaks down, all these exercises of the capital market line crumbles down. So that's why EMH matters so much. Number 4, corporate governance. Well, in this respect, we need EMH dearly. But what does corporate governance mean? ESG has been hot over the past decade. What do we mean by that? Environment, social, and governance, right? But here we are talking about this G. And for this G, you need EMH. Why? What is corporate governance about? Okay, strong corporate governance. What is having a strong corporate governance as a shareholders and then the publicly traded companies, right? Or privately held companies as well. But this having strong corporate governance means this for shareholders, okay? For shareholders, how much can you say this, right? How can I get my money back? That is about corporate governance. You, as an equity holder or shareholder, you put your precious money, my precious money, into that stock, right? And sometimes the CEOs can screw up the company, and you want to get, you get pissed off, and then you want to say to that CEO and say, I want my precious money back. how much can you do that? If you can do that, you have strong corporate governance. If you cannot say it to the CEOs, the governance is weak. Okay? My precious. Looks ugly, you will say, but we all have this ugly, selfish desire anyway. It's not bad. Okay? The money is your precious money. You earn this money with your career and effort and your hard work. It deserves your attention like this. My precious. Okay? How much can you say it to the CEOs? That's about the corporate governance. Now, the issue is the governance problem or agency problem, the economist way of saying the agency problem. When do we have that kind of things? When the ownership and control gets separated, then the agency problem pops up. In a word, your company, your mom and pop store, let's say you are burning not the frying chickens and then the fried chicken store, you have it in your restaurant. It's your 100% owned by you and your family. There's no governance issue because ownership and control is the same. No separation. If you don't work hard for your chicken shop, okay, or fried chicken shop, you're screwed. Okay, the owner gets screwed when he or she does not work hard enough for that company. No agency problem. But if your company grows so much so that you become only a partial owner, and then the shareholders gets a lot of shareholders are there, and you eventually appoint CEO, not you, but somebody else, like salaryman CEO, okay? In Robinson Crusoe, let's say Friday, okay? Let him work out, okay? And then hope and pray that he or she will work hard for that company, okay? Separation of ownership and control happens. Starting from that, you immediately start to have agency problem. Why? Because those CEOs have their own preferences. What's their objective function? Well, CEO wants to maximize what? What does CEO want to maximize? Be true to yourself. If you are the CEO, you want to maximize your own utility. Okay, utility maximization. Rational human being wants to be happy, which means maximizing utility myself. That's the agent problem. How about shareholders problem? Your objective function is to maximize the shareholder value. I want my money to be maximized. My precious. That's a principal's perspective. Okay, principal agent, they are different. There is an agency problem. Okay, the thing is, not all CEOs work hard for the shareholders. They have their own private agenda. Easily put, you never know what he or she is going to do behind that closed door. Okay. They can smoke a crack and doing something wrong and feeling happy so high. Nah, that's an agency problem. Okay. So how can we resolve this agency problem? Okay. We need incentive. Okay. Incentive alignment is critical. But how can we align those incentives so that the shareholders would be happy together with the CEO being happy? Incentive alignment. By giving economic incentive. The most important economic incentives in these days are stock ownership, so that the CEOs could become one of us, the shareholders. You get our shares and then, be happy together with us when you maximize the share price and work hard. And then if you don't work hard and work stupid, the price goes down. Not only me screwed up, but you get screwed up. Okay? Incentive alignment, ownership of the stock. Okay? That's one incentive. Another incentive is what? Stock call option on stock. Okay, call option. So you work hard, work smart, and the price goes up. You feel happy, we feel happy too. But things can happen such a way that you work hard, but the price may not go up that much for bad reasons. Maybe you're simply bad luck. You were unlucky, even though you took good risk for the company, but some helpless force, exogenous force, like COVID-19. Think about those travel industry. 2019, if you're a travel industry travel agent and you invested heavily in a smart way, but somehow unexpectedly this virus, the pandemic hit your business, screwed up. Now call option in that sense saves you a little bit, because shareholders may plunge down, but call option value does not go down. It's downside protected. Okay, it's like only on the convex payoff. When it goes up, you enjoy it, but when it goes down, you're protected. So it's a convex payoff that protects you reasonably. So call option. Okay, those two are predominant incentive, economic incentive, very important in corporate governance. But wait a minute, this heavily depends on one critical assumption, that is EMH. The price reflects information that you as a CEO work smart and hard. Make sense? Guess what? Okay, if this price failed to reflect the information that you work hard and smart, what should happen? Okay, is there any incentive that you want to work hard and smart? Perhaps not. So here is one interesting case. KD Media. This is a Kostak company in Korea. And in 2012, Gangnam Style took off. Okay, you remember that Gangnam Style bubble? Okay, 8 times of the stock price within 3 months with no fundamental information there, right? But related stocks, entertainment-related stocks, jumped up together with this bubble. And KD Media, the price went up together with it. But what was the reason there? Well, this company once made an album jacket to Psy like 5 years before. Not anymore, but simply because they had some historical relation with this rapper Psy, their price went up by 2 times or something. Now, my friend who was the CEO at that company at that moment complained to me, Andy, you know what? Our employees, okay, every morning they come to the office, they turn on the computer. What do? Every day, they're not shuffling, but look at the screen and time the market to sell their company stock. Oh, should I sell it right now? Tomorrow? Or should I sold it yesterday? Instead of working hard for their immediate present task. So the incentive effect of this ESOP, employee stock option plan, or call option, all these kind of things, no incentive effect. Okay, when the market is in a bubble, no incentive to work hard. Okay, so EMH, okay, is critically important to set up our governance structure correct. Okay, so that's that. Number 5, right? Allocation of capital across division of a firm. In this respect, EMH is important. But what do you mean? Allocation of budget, okay? It goes back to the chip war, our semiconductor discussion, okay? Now, what do you mean? I'm going to focus on Samsung Electronics, but here, related semiconductor company stock price chart is shown. NVIDIA. You see it ever since 2020, and it was jumping like this, and right now here. And NVIDIA's GPU, okay, what they do is only designing, but who makes that GPU chip? Okay, that's foundry called TSMC, Taiwan Semiconductor Manufacturing Company. Right, now, TSMC's stock price was moving or going up from about 25 to 120 within 5 years horizon. Oh my God. All right. Now, here comes Samsung. Okay, Samsung Electronics. Here's the CEO, or the third generation own, the founding family guy. Now, Samsung Electronics stock price over the same period started from 50,000 and then right now 62.8 thousand. Are you kidding me? 5 times or 6 times, and then what are you doing? Okay, but no surprise, man. You look at Samsung Electronics' closest competitor, which is Micron. Their price is not that much farther. Okay, from $50 to 87-ish or something. Okay, still better than Samsung. But what I'm trying to say is they're much more volatile. DRAM industry. Okay, why is that so? You're going to learn about it if you're taking my international finance class, right? Now, the nature of this industry of DRAM is like this commodity, right? Whenever it's going up, you go like crazily up. Whenever it goes down, usually it's just bottoming like crazy, and then you get digging the hole like crazy. So much volatile, so much risky. That's commodity business. DRAM, okay? Whereas the commodity, no difference. Billions of products, no difference, just like corn or rice, right? So that's why. In contrast, this foundry, it's not commodity, okay? It's more specialized. Okay, you can charge a large margins. That's why. Anyway, so for Samsung's perspective, you know, Intel and Samsung, they are bulge bracket semiconductor company. So they take care of the whole value chain, starting from to the end. Okay, they have many divisions, and here you see division heads. Okay, you see the pictures of them, and DRAM division head, and then foundry division head. Okay, the key issue would be, well, you see the foundry business is doing good, but DRAM business is not that good. Okay, and then where should we put our money? Because money is a scarce resource. Of course, you would say when it comes to money and resource-wise, you would not agree. Money is scarce to these guys, the richest guy in Korea. But if you study more, you will realize they are still limited. Okay, so money is a scarce resource. So how can we efficiently allocate this budget and invest so much so that you will maximize the shareholder value later? Okay, the idea is, well, put our money into the more promising area. Okay, going into the future, looking forward, whatever is more promising. Okay, so what could be the idea? Okay, use something called Tobin's Q according to economist idea. Or Tobin's Q, what is it? This is the ratio between the market value of invested capital and book value of invested capital, or market value of invested capital over replacement cost of those invested capital. Oh, so difficult to understand. What do you mean? The numerator, it's just like PB ratio. Okay, step back, and if you take a look again, it looks like PB ratio. In what sense? The numerator is market value. Okay, whatever the market participants perceive about the company. The denominator is a book value, of the same thing. Okay. Oh, but that's a PB ratio was about equity. But here you see invested capital. What do you mean invested capital? Well, assets, easily put. Okay, assets. What you got, what the company's got. Okay. How much do the market perceive for each dollar of asset the investors invested before? Okay, for each dollar of invested capital, how much is it perceived in the market? You want it to be bigger than 1. Okay, if it is below 1, you will regret. Oh my God. When would it be going up? Okay, when investors in the market perceive the area, the company, or the industry is promising, high growth potential. Okay, G drives PB ratio. You remember that part? Same thing for Tobin's Q. Okay, because the market price is about the future expectation, and what more is needed than the growth prospect. So higher growth prospect, higher Tobin's Q, or higher PB ratio, quite naturally it goes. Now, sometimes, so what is the PB ratio of NVIDIA? You remember that, and Micron. And then instead of Tobin's Q, we can discuss it using PB ratio, okay? Whichever division that deserves higher PB ratio, you want to put more money onto that division. That's the idea. So JY Lee, which division should he invest more if he has more marginal dollar? Okay, one single dollar is, he has extra dollar. Where shall I put? Shall I put into foundry business or DRAM business? Okay, that's where these two guys will fight like crazy. 머리끄댕이 잡고 like, I have to get more money for my division. You know, my division is more important. No, my division is more important. Blah blah blah. Okay, very fierce fighting will go on. But whose hand does he have to raise? Okay, look at the PB ratio. Okay, and go for the PB ratio that is higher, or in Tobin's Q term, Tobin's Q, higher Tobin's Q. Okay, put the money there. Okay, so that's the idea. Okay, and then so that's where this where your allocation of budget happens. But here again, it depends on a huge assumption, one assumption, that the market is efficient, EMH. Okay, why? The PB ratio, okay, should be correctly reflecting all these growth potential. On the other hand, if price is not correct, if EMH breaks down, if there is a bubble in one of the divisions, right? Like in foundry business, if that foundry TSMC is in full of bubble, can you trust that PB ratio of TSMC so that you would allocate more money into that foundry business? No. Okay, what if the bubble burst? Okay, eventually it will go down. You don't want to do that. On the other hand, if the DRAM industry is in a full bubble, would you allocate more money into that DRAM industry? No, either. Okay. So we try to use this Tobin's Q and then make a rational allocation decision, investment decision, assuming that EMH holds true. So in this respect, again, okay, EMH is a central piece for the neoclassical economics. I hope you understand all these 5 aspects where this the EMH is really important. Okay, so this is EMH, centerpiece of the neoclassical economics, social planner's perspective, and fair game in the market, and risk sharing among investors, and incentive and governance, and resource allocation, efficient resource allocation among divisions. All 5 aspects tells us that EMH is very, very, very important. If this breaks down, the economic theories start to crumble. Okay, so I hope you enjoyed it, and see you in the next lecture. Final piece. Wait.